Hello, you're welcome to FinInvest Niger. My name is Tom Princeville. I'm a certified securities and investment specialist, and I've been investing for the past 20 years. In the course of this video, I want to talk about the characteristics of successful investors, the attributes, the characteristics of people who are deemed to be successful in the field, in the area of investing. There's something I've come to understand, which is somewhat a little bit unpleasant as far as I'm concerned. People are more interested in you telling them what to buy. They just want to hear stock recommendations. Buy this, buy that, buy this and that. It will make you rich within 3 months, within 6 months, and stuff of that nature. Well, it's good to make recommendations, quite all right. It's part of our part of our work as educators when it comes to the stock market. But the most important thing is knowing what to buy and how to buy. You need to imbibe the knowledge that will help you to know precisely how to go about picking stocks and buying stocks. It's just like people are more interested in you giving them fish rather than getting concerned about how to fish, how to catch fish themselves. And that's why this particular video is very, very important, so that you, as an aspiring successful investor, should know precisely the kind of attribute and skills you will need, the character you will need to be able to successfully invest, as an investor. So we discovered that in this particular context, the very first characteristics here is long-term mindset, mindset. And so focusing on long-term value creation rather than on short-term price movements, in the market, or what we call noise. Generally successful investors, they have that long-term mindset. Okay, they're investing for the coming maybe 3 years, 5 years, 10 years, 15 years, not just short-term market, not just being governed or directed by short-term market noise, entering the market today and exiting tomorrow. You will not be able to compound adequately because short-termism, kills investment success. And that's why someone said that time, all right, is the friend of the investor. The longer you hold your stocks, the longer your time horizon, the more you are going to get better results out of it. Somebody like Warren Buffett, the world's richest investor, started investing at the age of 13 and is now in his 90s, accumulating great wealth of over $100 billion, dollar over the years. So have that long-term mindset. Number 2 is strong discipline. So in this case, you follow, a clear investment strategy and avoid, impulsive decisions driven by hype or fear or greed. You must have precisely, a guiding factor, a framework within which you want to carry out your investments. You should be disciplined so as to avoid being controlled or governed or distracted by the normal market noise in the market. That is what you should inculcate as an individual who want to be successful in the field of investing. Number 3 is patience. Patience is very, very important, because if you are impatient, it will not all go well, as far as returns is concerned with you in the market. So you understand that wealth in the stock market, is built over time and allows investment to compound. Just like I told us earlier, you need to build your wealth over time and give your investment time to compound. Don't just jump into the market and jump out of the market. The market is not a get rich quick, scheme. It's the matter of building wealth gradually, with the concept of patience in mind. Number 4 is risk awareness. You need to recognize that all investments carry risk. Okay, and you also need to manage it through diversification and position sizing. In other words, you don't buy just a single stock. Somebody made a mistake of buying a single stock. All right, he bought shares of Zenith Bank, huge amount of money, about 20 million or so thereabout. He was able to get a little profit out of it, and they went and put the entire money in Access Bank. And as we all know, Access Bank did poorly, in the past 2 or 3 years. And that's how he lost a substantial part of his money. Okay, so you don't just invest in a single stock. With 20 million naira, you could diversify into as much as between 10 or 15 stocks, as the case may be. He went and put his entire holding, his entire capital in a single stock. You don't do that. You have to reduce your risk by diversification. You need to be risk averse and be aware of the risks that surround as an investor, and know how you could go about, diversifying and sizing your portfolio adequately. You have 10 stocks, or you have 10 or 20 stocks. You divide your money into in equal proportion, and then invest in those stocks. By so doing, you've ended up reducing your risks, immensely. The next one is emotional control. Is emotional control. Whether I would like it or not, we are all emotional beings, and generally, men are sometimes controlled by emotions rather than by reasons or logic. When it comes to investing, as much as possible, don't be controlled by emotions. Keep your emotions aside. Keep emotions like greed and panic in check, especially during market volatility. The market will gyrate, the market will be volatile. Stocks will swing up and down. At that time, maintain discipline. Be resolute not to be carried away by mere noise in the market. Make sure that you adhere to the company's fundamentals you've bought. And as long as the fundamentals remain intact, you don't sell. You don't allow the noise around to control you. So don't allow emotion to come into play when it comes to investing. The next one is continuous learning. Continuous learning. So you have to regularly update knowledge about the market, about businesses, and about economic trend, because the moment you stop learning, you stop updating yourself, that's the moment you start declining in knowledge as an investor. So for you to be at the top of your craft always, you need regular learning, regular updates. You need to be in the market on a daily basis to learn one or two things. It will help you to boost your returns on investment at the end of the day. The next one is independent thinking. Independent thinking. Human beings naturally, we have that tendency of following the crowd. All right. But when it comes to investing is not a democracy where the majority carry the vote. It's almost like the other way around. Okay. And so make sure that you are ruled by your conviction, not by what the crowd is doing. In other words, when the crowd is selling, that is the time for you to buy. And when the crowd is buying, that's the time for you to sell, according to Warren Buffett. When people are greedy, you do what? You sell. When people are in a panic, you buy. That's how to make money in the market. When there's blood in the street, according to somebody, that's when to buy stocks, in excellent stocks, at a very cheap price. So don't follow the crowd. Learn to be independent. Learn to have what is called a kind of contrarian thinking. It will go a long way in helping you. So don't blindly follow the crowd. The crowd is never right. It's not always right. They are sometimes right, but not always. So make sure that you stand your ground. All right. You've made your investigation. You've done your research. You've picked your stocks. Stay with your stocks. The price may fluctuate as long as the company remains profitable, and as long as the fundamentals are still intact. The narrative by which you buy the story, are still there, and it's still relevant. Don't sell. Okay. Maintain independent thinking. The next one is clear investment goals. Clear investment goals. So in this case, you invest with specific objectives in mind, such as growth. You want to grow your investment, such as income. You want to receive regular dividends, or capital preservation. You simply want to preserve your capital from losses, from dwindling in value. So make sure that your investment goals are very, very clear. They are concise. They are understandable, or else you'll be investing haphazardly without a sense of direction. And so it's very, very important that you have a clear-cut written down goals that will govern your investment always. And the next one is realistic expectations. Understand that consistent, reasonable returns are more sustainable than chasing quick profits. You don't just chase quick profits. You don't want to make it overnight. No, that isn't the way investment is being, is being carried out. No, you don't do that. You don't say, well, I want to invest. I expect to double my money within 3 months, within 9 months. That is not being realistic. Okay, so just invest that. Well, I want to have a high double digit returns, maybe 25, maybe 30, maybe 40, 50, 60, as the case may be. But let your goal be realistic. Have a realistic, clear investment goal. It will help you. It will help you a lot. And not only that, you must have um a strong a strong analytical skills. Well, you may not really be a big mathematician. You may not really have a kind of degree in mathematics or accounting. You don't really need that. Okay, you don't need to accumulate advanced mathematical skills. Somebody said if you come across anything raised to power 2 or 3 or whatever, it's no longer investing, you're doing something else. So you need basic accounting principle to understand, be familiar with basic accounting principle. Okay, for instance, now personally, I am not an accountant. I I did mechanical engineering, but I understand basic accounting. That is just what you need. You don't need to have a very high IQ. Okay, just elementary accounting and you are okay. So you need to know how to evaluate companies based on fundamentals such as earning qualities, financial strength, and debt level and the overall business model the company is adopting. What the company's business model, what's the strength of their balance sheet. That is what you consider. You don't just need high level accounting. You don't need to be a chartered accountant. No, just elementary accounting is okay. Elementary analytical skill will really serve you. And the next one is consistency. Consistency. When you come to this particular aspect of the characteristics of an investor, you apply the same investment principles across different market conditions. You are consistent. All right. Say, okay, this is my strategy. All right, and you stick to it. Not that today you are a value investor, next tomorrow you are a growth investor, the next day you are a momentum investor, the next other time you are an intraday trader. Intraday trader. You keep on swinging from pillar to post. No, have a clear-cut investment object, investment, strategy, and be consistent with. Somebody like Warren Buffett, what is his strategy? Is value investing, buying quality company when they are cheap. Buying quality companies when the price is down. You buy cheap because generally you make money when you buy, not necessarily when you sell, and be consistent with that particular attribute. Then we now come to the other one is humility. You must learn to be humble. No matter how many years you spent in the market, learn to be humble. Personally, I've spent about 20 years in the market, and by God's grace, I have learned to be humble. If you're not humble, the market will humble you. And when the market humbles you, you will lose money. You will lose money almost in millions. All right. So learn to be humble and believe that you don't know it all. Always learn from other people who are in the business, who have gone before you, who have spent years in the market. Learn from them. Be humble that when you're humble, actually, it will help you to be able to be willing to learn. And the more you learn, the more you understand. The more you understand, the more it will impact on your return on investment at the end of the day. So you must accept mistakes. You must learn from them. You must understand that no investor is right all the time. In one of my videos, I spoke about mistakes investors make. Okay, and so you learn from your mistake and vow not to repeat them again. Be humble. The lower you are in humility, in fact, it translates into the kind of returns you make at the end of the day. Not only that, there's a capital preservation focus. You must focus on capital preservation. A would-be client called me and asked me, how much do you think I can make in the market if I give you this amount of money to manage for me? I said, I don't know. I cannot tell you. I can't give you guarantees. Okay, my job is to make sure that you don't lose your money. All right, to ensure that your capital is preserved. Once your money is preserved, and then we'll not focus on doing generating returns, but we'll not give you guarantee that you're going to make such amount of money. No, we don't do that. All right, we don't do that in investing. There's no guarantee at all. We labor to make sure that you don't lose your money. So you have that particular capital preservation in focus. We prioritize protecting capital before seeking high returns. protect the capital first, and then the returns will come in later, and not the other way around. The next one is adaptability. You have what is called adaptability in this particular concept. So you adjust strategy when market conditions or fundamental changes without abandoning core principles. Your core principles should be intact, but you tend to like tweak and make adjustments as the market dictates. That is, don't be so rigid that you don't bend, you're not flexible. No, you watch the overall market and then tailor your principle, tailor your strategy based on overriding market conditions. Okay, in other words, you are able to adapt, you are flexible, while not abandoning your core principle as an investor. Then the last one here is ethical and rational approach. Ethical and rational approach. So in this case, you avoid speculative behaviors, based on based on tips and hypes and rumors in the market. No, be very, very logical in your approach to investing. Be logical. Be logical. Don't allow hype and rumors to govern your investment. No, invest based on fundamentals. Be ethical. Don't do what is wrong. Don't cut corners, because eventually it come back to haunt you, and to even lead to losses that will be very, very difficult to recover. Please do me a favor. Okay, subscribe to this channel, like and share this video, because I want to reach out to at least a million Nigerians with this message about investing. That is my heart desire, that many people will come to understand what it took me about 20 years to learn, in videos of this nature. And how can I accomplish that? Is by you subscribing and as well as sharing this video. Please, I'm banking and depending upon you, in this regards.